Hey everyone, it is showtime. I have to let you in on a little secret. Dave and I have been waiting in separate rooms for the last 10 minutes, waiting to come live. And so, Dave, I'm glad you're in the same room with me now.
I am too. I was getting a little nervous over there that I was going to have to try to run the show myself again.
We do so many of these shows, we schedule so many rooms, and it's bizarre when we're sitting here waiting because normally we have a good 10, 15 minutes to talk beforehand, make sure everything's set up properly. So today, welcome. Wow, it's just brand new.
It is. We're here. We're ready to go. We've got everything working, it appears. So hopefully we can get everybody some questions answered and get through 30 minutes of helping people with their retirement.
Dave, everything go well for you this past week so far?
It's been okay. Still having some issues with my ear. Can't get that solved. I've had some insurance issues I'm trying to resolve, which finally are resolved. I got them resolved this morning. But other than that, can't complain. What about yourself?
It's been cold like normal. We're in Utah where the snow always comes in. And now it's weird because when you're in their 35s or 40, range, it always feels warm to me now, which is bizarre.
Yeah, it doesn't for me yet. I still have that Puerto Rico blood in me. So now we're at 40, 50. I'm ready to go back to 70 or 80.
Yeah, I would still be happy with warm weather. Don't get me wrong.
So have you decided to move the farms into the game room or something yet to protect them with all this cold you've got going on, or do you got a nice little place outside for them?
No, we have a little shed, and then next to the shed, I built two other parts of sheds there. So they're all covered, taken care of. Everyone has a little time, but no matter how cold it is, I go out there. My sheep are always sitting out in the snow. Even when it's a blizzard, they go sit out there. But my chickens, they're definitely hiding inside.
I guess that's what happens when you've got a wool coat, whatever you've got there, wool coat. That's what happens when you got a big wool coat. You can sit outside.
That's right. Yeah, I definitely have to go out there and brush it off and clean up quite a bit, though.
Yeah, I would imagine. Yeah, I would imagine.
Well, I just want to remind everyone who's watching live to go ahead and submit your retirement questions. Let us know where you're watching from. Join us in this live show. Again, we're on Facebook and YouTube. So it's always a fun time to come on and celebrate, talk to Dave, and go through all of these questions that we get to throw at him. Again, we talk reverse mortgage, we talk Social Security, Medicare. Dave, we just kind of really dive into everything to kind of deal with retirement, right?
We do. Whatever your question is, you ask it. We'll do our best to make sure you get the answer you need to help you get to that safe and secure retirement you're looking for.
And those watching on replay, if you have a question, go ahead and submit that at theprosperityguy.com. We'll get those questions answered for you as well. So, Dave, if you're ready, let's dive into the show this morning and let's see if we can get going.
Let's do it.
All right. So my first question I have comes from Jeff. Jeff says, why are the contribution limits to IRS so much lower than contribution limits to 401k plans?
I believe what he's asking there is IRAs, not IRS. It would be nice if we had low limit contributions to the IRS. The lower, the better. As a CPA, that's part of my job, trying to get those amounts down as low as we legally can. I think Jeff's asking here the IRA amounts, why are they so much lower? This is something that many people are talking about that needs to be changed. It was established by the government. I can't give you all the guidelines on why it was originally established, but people realize there's a problem, that there are so few 401k plans out there that people need to be able to put more money into these individual accounts to where they can better plan for their upcoming retirement. They can take advantage of the tax benefits that are offered, depending on which of the two buckets, tax deferred or tax free. They're needing to put that money in to get the appropriate amount in the buckets, but it is being discussed. There are a lot of people that want to see that changed over the next few years, and I would assume we'll see some changes. Now, it may not go to where we'd like to see it, to where they match each other, but I would expect some changes here as we try to help more people save, help more people plan for retirement. Unfortunately, CR, what's happening, so we've got a situation where we were slowly going up, people are getting better, and now, unfortunately, especially since COVID, we're almost on a nosedive of people just taking retirement off the table. They're not saving. They don't have the money they need. And it is something that's really got to be addressed as a American public in general to see what we can do to help it out.
And Dave, we talk about 401ks, like even at work, those employment places that match. Isn't that a no-brainer just to put at least that money in to match that, whatever your employment's offering?
Yes, it is. This is free money that you're being given. Now, some of you have great plans. I've seen people as high as 10, 15, even up to 25% that's being matched. If you've got one of those, you definitely want to take advantage. But even if they're only matching 1% or 2, that's free money that they're offering you from your company to put into your retirement. All of us need as much money in those plans as we can get. So go ahead and take advantage of the money that they're offering and match it to that level.
And what do you think people are taking retirement off the table right now? Why is it such an issue at this point?
Economics, a couple of things. Economics are an issue. People are struggling. There's a group that's struggling out there. Two, we become addicted to debt. We would rather buy stuff, have stuff, than worry about what our future is going to look like. And it's not just the citizens, the country itself. I mean, we're over $28 trillion, CR, reported on the books of liabilities that we have as a country. And the unreported is closer to probably 200 trillion. So we've gotten addicted to debt. We would much rather solve our issues today than take some pain today with the hopes of brighter tomorrow. And it's going to require people to make those transitions if they really want to have a retirement that looks anything like their working years for most people.
Definitely with the COVID relief packages and things like that, I can just see that money, just the debt from our government continually just to skyrocket.
It is. And we've got trillions of dollars more that's coming out. I mean, we're almost at a point that they've taken off the belief that somewhere there's a day of reckoning. That somewhere in the future, anytime you take any debt, if you're taking student loan debt, we see it with many people. If you're taking debts for a home, if you're taking debts for a car, credit card debt, all of those, there's a day of reckoning at some point. When's that going to come with yourself? Oftentimes you can kind of project it out when it's going to happen. Government, we don't know, but many of the top economists are saying somewhere around 2030, another 10 years from now, we're going to have some major issues, especially if we keep spending at the levels we are now.
Exactly. All right, Dave, let's get to my next one from Cheryl. How do you distribute property? I'm assuming you have to sell property.
So what she's talking about here is if you've got property in a self-directed plan. So if you've got a self-directed IRA, 401k, where you're handling everything, you're taking the advantage of the alternative investments that you would be able to put into these retirement plans. What happens is you end up just taking the property out, transferring title, and then a 1099-R is reported to the government telling them that you took a distribution out of your plan. So we see this, CR, primarily when people have a home. Maybe you want to move to Tennessee, you'd love to come here, but maybe you're not ready to go yet. So you end up buying a home here, rent it out for a period of time. It's inside of your retirement plan. Then you get to retirement and you say, I'm ready to move in. I'm ready to leave Utah and come to Tennessee. That point, you distribute it out because you can't live inside of that home if it's inside of your retirement accounts. You distribute it out, and then it just becomes your primary residence once you get here. So we see that happening a lot with a lot of people.
As we're getting into retirement, what about property? And we've talked about this on other podcasts, but is investing in property a good idea to maybe help toward retirement?
If you structure it correctly, I am not a fan at all of people putting assets such as real estate in your taxable bucket, because you're going to have taxable income for the rest of your retirement, and you're going to probably have provisional income for the rest of your retirement. Now, if you've got the assets and you can structure it into a self-directed plan, all for it. I'm not against real estate in general. I think it's a great option for many people to build net worth. It's something that's tangible. It's always going to be there. So I don't discourage people from investing. I just want to make sure as we look at these other risks, that we're structuring things to where these other risks don't destroy the income that could come off of this real estate that you've got in your taxable bucket.
Definitely makes sense. All right, Dave, let's go to Bonnie. Bonnie said, what if I sold land I already own to my son? Could he buy this land in a self-directed IRA?
No. So this is a self-dealing issue that you've got. You've got people that you cannot do transactions with, and you've got transactions that have happened before that you can no longer include in your retirement. So if you've got assets that you've owned here, so we've got a piece of land. If someone owned that land prior to wanting to get it into the retirement, even if they sold it, they still can't go back and buy it and put it into a self-directed plan. And once they've owned that property, they cannot do a transition into the self-directed plan.
What if you gift something like this? I mean, does that change up the scenario a little bit?
No, not really, because again, if they've already had it, and again, there's individuals, lineal descendants that you can't do transactions with. So, if you were gifted it into your individual name and then you said, hey, I want to contribute it as part of the assets into my self-directed, you can't do it once you've touched that asset. Now, could you use self-directed assets to buy from a cousin or an uncle or even a spouse's family members and it's your own IRA, yes, because they're not lineal descendants. But if you've got parents, children that are trying to do transactions amongst themselves, you're going to have some issues.
Okay, that's good to know. All right, let's get to Twyla. What do you mean you can't bury your gold or keep it at home?
Yeah, what they're talking about here is with your self-directed IRA. So there's some laws. Many people want to invest in gold and silver right now. There's a big rush on silver, I guess, because of the same reason there was a big rush on GameStop. People are trying to take advantage of what's going on from big companies and their short selling and their thoughts that these products will go down. But the situation is many people want to bury this in their backyard. They want to keep it. I know when I lived in Las Vegas, there was one of the big casino moguls that buried millions of dollars of silver out in the middle of the desert. Now, luckily, he was the only one who knew where he had buried it, so nobody went and dug it up, but he had put millions of dollars out in the desert. You can't take physical possession. Now, your custodian can. Other people who handle the assets for your self-directed plan can hold those assets, but you yourself can't. Too easy for you to just take those assets and start self-dealing outside of the IRA if that's the case.
And Dave, I'm glad you brought up GameStop, because if we look at something like this where you jump on the bandwagon late in the game, does that help you get toward retirement any quicker?
No, I've seen it so many times, and GameStop's an interesting one. I don't know where it's going to end. I've not followed it. You see all the situations where the government's getting involved. You see places like Robinhood who shut down their trading that became very frustrating to many people. So I don't know where the end of the game is, but the problem is time after time after time. By the time it gets to you, usually it's too late. The people are in the know that follow this stuff. They know what's going on. They've made their investments. By the time you get it on the local news, if that's where you're getting your information, it's usually too late. I saw it with the .com boom back when we had it during the late 90s. Saw it with the home mortgage market. We saw people in Vegas, especially, which is where I was living at the time and working. You saw people trying to double their money, and then they got slammed at the back end. And we saw it with Bitcoin, same thing. I've seen that happen many times where people got in late and shouldn't have, and then they got handed, fortunately, a big loss on their tax return because they'd lost a bunch of their assets.
I just thought it was interesting. And the reason I brought up GameStop is because as I was following it, a lot of people were saying that they completely wiped out their retirement to put everything into GameStop. And that kind of defeats the purpose of why we're here today, to do everything.
Yeah, and that's part of the problem too. I mean, there's guys that understand it. I mean, there were people that were involved in the middle of it. The guy who started the process, I think, was out of Massachusetts, financial advisor. They understand what they're doing and they know what they're doing. So it's easy for them to make investments, know when to get in, when to get out, what the product's going to do. Well, the average investor that doesn't know that, what you've done is fallen into greed. I mean, you might as well go to Vegas, put your money on red or black and spin the wheel and see what happens. Because unfortunately, for many people, that's about how well it's going to turn out for them. So yes, some will win, but you've got a really high probability that you're going to end up losing.
Exactly. All right, Dave. Antonio asks, how are you able to take a salary from CCorp without being a disqualified person?
Antonio, this also, and CR, this is coming from the discussion that we had, the webinar that we had on self-directed plans. The rules are that if you have a IRA, you're not able to take wages out of any investments you have inside of there. So let's say that you've got rental property and you want to pay yourself a wage or a management fee for managing that. You can't do that. Well, when you've got a solo 401k that's set up with a C corporation as an investment inside of there, you're able to take wages out of that C corporation. Just like if you were dealing with Microsoft or GameStop or anything else, I mean, any of these corporations you could invest in the public, what you're doing is your solo 401k is investing in the stock of that company. And therefore, it's not preventing you from being able to take wages out for services that you would provide for that company. We see many people, I know Gary Wong's been on our show here a number of times. One of the questions he often asks about is plans that are set up for startup businesses. And this is where you'll see the structure used many times, where you'll take self-directed funds, start up a new business. I think they call it ROB as the acronyms that they use there. But they're using those funds to start a C corporation that'll operate the business. They then make some money during the working years and allow the equity and growth to go into the retirement plan over the length of the business and the time they have that business.
Dave, I see this as if you don't get the proper advisor or somebody to help you through a plan, I can see you getting into trouble if you're starting to go down this path.
Yeah, 10% of America CR is about it should be in the products that all that should self-direct. Right now, they're 1 to 2%, lower than it should be. But most of America should go down this path. And so many people that went down the self-directed path and to make something they didn't understand worked. And that's just not the way the world happens. I mean, you'll have one of 100, and unfortunately, the sales guys that are going to tell you the story of the one who made it work. What they forget to tell you is those 99 people that lost retirement in something they understand and they didn't know how to make money out of.
It's definitely a bizarre case, but Dave, let's keep moving on here. I've got a lot more questions. I'm trying to get in here and squeeze in our 30 minutes. My next one's from Mary. Pros and cons of taking pension in payment or lump sum and putting into a 401k.
Mary, a lot of it's going to come down to the type of pension that you have. Is it inflation adjusted? How much money is coming out of there? How can you put it in a situation where you can guarantee income for both you and your spouse? Is it a double lifetime income payout? You're going to need to look at all these things. We do see a number of times where it's recommended, and I've done it before myself and working with clients where we'll recommend to take the lump sum because it's going to provide more income or more security when we look forward. Another big issue you've got, many of these pensions CR are way underfunded, especially if you've got a state or government pension and you're in the wrong state like New York or somewhere like that. Those plans are so underfunded, at some point there's a day of reckoning. Can they keep going the way they're going? Puerto Rico's got the same issue. Some point there's going to be a period where they just can't pay the bills anymore. Well, up to this point, they've been able to work different things out, but you've got to look at those risks as well and say, is there a chance that I lose that pension because of how underfunded it is? If I take it now, I can invest it in principal protected products. I can have more security going into my retirement. So it's going to be a case by case situation, but there is a valid reason for many people to take the lump sum versus taking those monthly payments.
And Dave, we've talked about this many, many times, but I feel that people like Mary are pretty fortunate to have a pension when they're completely going away with these.
Yes, 13% of America is all that has pensions now, and they are very lucky because it isn't something that most employers are providing. If they are, it's usually a very small percent of your retirement income. So should be grateful that you have it, but it is something that should be analyzed. You shouldn't just accept the fact that I have a pension as a fact that I should now start taking at 65 and just move forward. If you've got some options based on yours and your spouse's life, if you've got options, take a lump sum. And you want to look at all of these things so you understand what the right move is going to be for you going forward with it.
I look at those people too that may have a pension and they say, hey, I'm just going to survive off my pension or maybe just throw in some Social Security. But we always talk about having multiple sources of income. And I feel that some people in this area get kind of complacent and they just feel like I'm set, but then they don't try to diversify anytime in the future.
I'm working on a plan right now. In fact, later today, I meet with the couple. They've got a situation where they're fitting right in there. They both have state pension plans and they both have Social Security. So their income in general is pretty stable throughout the rest of the retirement, but they want to retire at age 62. Social Security, if they take it at that age, is going to take a big hit versus waiting until age 70. Almost impossible for us to let them wait till age 70 because if we do, they have to spend down the other assets they have to where if they've got an emergency or if they have aspirational expenses where they want to go on vacation and spend tens of thousands of dollars, they're not going to have it. So it's a really hard situation that, yeah, we can have the income, but if we don't have other assets, we're going to be stuck in that income stream. Now, what happens with most people if you're stuck in the income stream? Well, then you go out and start borrowing additional money to cover these things. And now you're just perpetuating the problem because now in retirement, you're paying interest on items that you wish you would have been able to pay cash for. And it just compounds an issue going forward into your retirement years.
Definitely something to look at. All right, Dave, let's go to James. James says, can you quickly repeat the buckets of savings, tax-free and tax-deferred?
Yes, the three buckets that I talk about in my planning are the taxable, tax-deferred, and tax-free. Very simple when we look at overall planning. There's a million different options out there that you could use, but we really break it down to these three buckets. We want about 6 months in your taxable bucket, 6 months of basic living expenses. We want somewhere less than 250 to 500,000, depending on single or married couple and your tax deferred, and then everything else in the tax-free bucket. If we structure that correctly, what we find is that we can remove one of the biggest risks you're going to have in retirement, and that's those tax rates going up.
And are you seeing people take advantage of these buckets? Because I feel like this is a new concept for a lot of people.
No, I mean, we're seeing more people jump on because of the message we're sharing, and people like David McKnight and others who are out there spreading the word like preachers on the street corner. But when you look at it from an overall perspective, 95% of retirees still haven't messed up. They've got in the wrong bucket. And every time I do a webinar, one of the comments that we get at the bottom, we get these testimonials to talk about the webinar. There's always a comment in there saying, I wish I would have known this sooner. I wish somebody would have told me this years ago, because they understand the risk now. And, for some people it's too late. Others, I say, hey, even though you're in retirement, let's look at it. Let's see what we can do. Something could be better than nothing. But yeah, people are realizing that it is the way of the future and we need to prepare for it.
And such a great concept. And that's why we're here. I mean, I feel like these three buckets are what propelled us to kind of be everything of where we are right now.
It really is. When we got started, we were really focusing on tax rate risk. But as we got more involved, we realized there's a ton of other risks on the table that we need to eliminate. And that through appropriate planning, we can help people get those risks off the table.
Exactly. All right, Dave. Tom asked, what are income limitations for opening a Roth IRA?
Tom, you do have to have earned income. So whatever you're going to contribute into that account, you're going to have to make at least that amount to go inside of there. There are some restrictions if you make too much, but if you have zero earnings, so you've got maybe a job that you're not getting paid for, like my kids, but if you're that person, you're not going to be able to contribute. But as long as you've got earnings, you'll be able to contribute up to your earnings amount.
And anything Roth, is that still okay to be able to put your money in?
Yes, it is highly recommended for everyone out there because of the tax advantages of it. And you've got historically low tax rates. And when we look to the future, I've been reading David Walker. We talk about him on many of our webinars. He wrote a new book talking about whether the U.S. could be a superpower in 2040. So he's looking out 20 years and arguably is the most knowledgeable person on economics in the country. He was inside the government for 20 plus years of his life. And since then has been out in private industry. Well, we look at that and what we find is that the understanding he has of the program, we've got some huge concerns going forward with tax rate risk because of the overspending that just continues to happen on a daily basis.
Definitely recommend his book. You've read that how many times? Probably a bundle of times now.
Yeah, the new one I just barely got through last night. I just barely finished the new one, but it just came out. The other one, Come Back America, that was written clear back in 2007, 8, 9, that area. That one I've read a couple of times now, but just great information. Now, I will tell you, it's a little bit depressing. He does give great solutions. The problem is we've got to get the government to act on those solutions. And he himself has been pounding the government for decades now to get them to act. And unfortunately, most haven't, some have, but he does provide solutions. But when you look at the overall outcome, it's pretty bleak.
Yeah, he definitely has. I mean, I would say he has that mentality of the sky is falling and really wants to bring awareness to people for the right reasons. But people aren't just grabbing onto this. They just don't recognize it. Even in the government, they just don't care.
What I love about David Walker is he realizes math does not lie. And he's a CPA. I mean, he was the CPA of CPAs for a decade working inside the government. In fact, he was the first Comptroller General of the United States that left his post early. Every other one stayed there, but he left his post because he realized there was such a problem. And he realized that internally they weren't listening to him at a level they needed to. So then he went out and started doing tours across America. I think it was called the $10 million a minute tour. That's how fast the debt was going up, $10 million a minute. He went out, now it's higher than that. Now it's way above there. But he went out and did this tour. And I just love his integrity. I love the fact that people were bullying him into trying to change his philosophy. He said, no, math's math. Just this is the way it works out. And you've got to deal with the fact we've got a math problem.
Yeah, exactly. Dave, let's jump over real quick. We have a live one coming in. We have Gary Wong, and Gary said, should only qualified annuities reside in a Roth vehicle?
Gary, let me try to answer your question. You may have to provide some additional information here. I mean, when you're looking at a Roth, you're going to have a qualified annuity. It's going to have to be structured with dollars that have gone into your retirement plan, whether it's was in a traditional account before. Now you can roll it over, that money over, if set up with the right companies. You could roll it over into a Roth account. But yeah, my recommendation for most annuities now is going to be inside that Roth bucket. Now, you could set up a qualified annuity in a tax deferred bucket if it fits within your guidelines. So where you have not too much income or assets inside of that bucket. But yes, really what you want is that annuity go inside that Roth bucket so that you can take advantage of the tax benefits. Never have to worry about tax rates in the future.
And Gary, if you have a follow-up with that, please go ahead and submit that and we'll keep moving on here and get to some of our other questions. Now, Dave, I'm probably going to slaughter this name here, but Daksha is what I'm going to go with. I'm sorry if I'm slaughtering this, but at what age do you recommend an LIRP?
We talk about this a lot, Daksha, when we do our webinars, when we do these events with my podcast. I talk about it many times. It's not so much about your age as your insurability. What you need to understand is, unless you meet the qualifications of insurability, these items are really taken off the table. Like I talk about it for myself. I had a kidney transplant in 2019. There's no way I could get a low fee life insurance retirement plan now. Luckily, I had my plan in place before that ever happened. So I was able to get low fee insurance. Well, you've got 65-year-olds that we're working with that are able to get the low fee insurance because they're very healthy, taking care of themselves. They exercise every day. They eat right. Or we've got 30-year-olds that have medical conditions they can't. So when we look at it, what we find is that most people are putting these into place during their 50s, late 40s, 50s, going into their mid 60s. But I would recommend it for anyone as early as you can afford to do so. Start getting that money into the tax-free bucket.
And Dave, I was going to ask that because I feel like this is one of the questions we get asked all the time is, how early do you start? What about my children? What about if I'm already in retirement? There's so many that come up with this particular question. I'm glad you addressed that.
Yeah, and you've got to look at it from your own side, because there are people that I meet with that are younger, that are in a position where they could buy a life insurance retirement plan, but maybe they don't have the consistent income they need. Maybe they need to start filling up that Roth bucket first, getting some money in there, or even some of the tax deferred bucket, getting some excess money in there based upon their income situation. So it's going to be a fact and circumstances play. But yeah, you'll find that for everyone, it's not going to happen at a given age based upon all the requirements and the laws governing it.
And Dave, I think for our last question here, Maureen asked, does it make sense for retired to convert traditional IRA to Roth?
This is another question we get quite a bit, CR, when we look at it, as people get into retirement and they think it's all over. The game's done. I'm in retirement. I reached the finish line. Well, you really didn't reach the finish line. In fact, for many of you, you've reached the midway point. You've gotten to a point, yes, your lifestyle's changed, you're not working, but for many people, retirement could be much longer than their working years, depending on how long they worked, the education they had prior to that, or their marital relationships. So we got to look at it that we are on the path down the journey. We're not there yet, which means we still have time to make changes. For many retirees, it's a great time to transition because they don't have earned income like many working people do that may take up part of the tax brackets that we're able to use to do the conversions. So, Maureen, I would say yes for most people. Now, again, we've got to look at your facts and circumstances. How much money do you have? What your income needs? What your life expectancy? I mean, if you're 96 and on a ventilator, yeah, probably not going to recommend you take that move. But again, maybe you are. If this is going to go to your kids and they're in their high earning years and you're able to transfer it out at your current tax bracket without giving it to them at their high brackets, even the lady guy on a ventilator at 94 may be the right time to do that conversion.
Dave, do you see a lot of people that just get to their 60s and say, hey, I've made it. I've accomplished everything. And they kind of give up on all the retirement pieces because they feel like they just crossed that finish line, where you're saying this is actually the kind of the middle of the race. You're just getting halfway there.
Yeah, this is the point that you really should start doing the planning, because unfortunately, most of you didn't do it before. So it's now you got time. There's no excuse. You can't blame work. You can't blame kids. They're hopefully out of the house by that point, or if not, at least at the point they're taking care of themselves. So now you've got the time to take care of it. And we do hear it far too much, CR. Unfortunately, we've got people that get to this point and they want to follow the set it and forget it plan we talk about, where they just want to put it on autopilot. Again, talking to someone the other day, had this situation. She's like, my husband thinks we're great. Well, why does he think we're great? I don't know. He just thinks we're great. We shouldn't have to worry. Well, she's on this phone call saying, look, I realize we got to do this together at some point, but I'm scared. I don't think we have the money we need. And I want you to confirm whether we do or not. So I do see that as well, where sometimes we've got a difference with the spouses, where one's burying their head in the sand saying, don't worry about it, we'll be fine. And the other one saying, look, now's the time to take action. It really is, CR. In your 60s, you can do a lot of things to change your retirement. In your late 70s, early 80s, most people, almost impossible for them to make large changes, because for most people, you can't go back to work, or you can't make changes in your lifestyle at that point. Usually they're going to affect much.
And again, you'll answer more questions as it gets to it. But people say, when I get to my 60s, I'm done for. This is it. I've already made all those decisions. But I love that you're saying, hey, this is a great time for you right now to really adjust what you're doing, because like longevity, it's there. We're gonna be alive a lot longer. And I think what you brought up is a great point to let them know that, hey, this is a good time for you to pivot and make more adjustments.
And we see more people trying to retire early, probably at least 2 times a week. I mean, we've got a ton of clients coming in that are talking to us on a regular basis. But I would say at this point, about 2 times a week, we get a new client coming in that wants to retire somewhere around 59, 60. And I'm not against that, CR, but I think there's 2 things you've got to look at. One, the math isn't penciling for most of these people. There's just no way they're going to get through another 30 to 40 years of retirement with what they've saved. And number 2, you got to look at your emotional health. I'm not saying you can't find things to do, but work does a lot to keep us motivated, gives us a place to go, keeps us interacting with people, allows us to use our skills and our mind. So you've got to look at that side too. I see far too many people that get in retirement and go back to work because they just can't handle it anymore. But that second job usually pays them a lot less than what they had going into retirement.
Yeah, exactly. Well, Dave, we're out of time. I do want to let everyone know that those who missed out, you do have an amazing webinar coming tomorrow, The Changing World of Retirement. It's a 4-hour class. It's super hard to get into. So if you haven't got into it, don't worry. Dave and I have planned some other dates coming up. So we'll have those for the next couple months here. We only let a small handful in because it really is a focus group to get to the point of what retirement really is. Dave, what are your thoughts on that, so we can kind of get people that are ready to get into that class coming in the next few months?
I would make the time. I know 4 hours seems like a long time. It does to me. This is going to be the first time I've taught a 4-hour class. I like to stick to the 1-2 hour classes. We do that with Social Security. We teach a 2-hour class, but I'm very excited for it because of the amount of information we're able to provide. If you've been to my other webinars, yeah, we're going to touch on items we've talked about before, but it's a whole new deck of slides, whole new concepts, new information that's coming out there. And in 4 hours of time, you're going to have a really good idea of where your retirement stands. Now, we will take a little mid-break. I'm hoping, CR. I'm expecting that. You'll get a little 10-minute break or 15 so we can take care of things we need to. But it's going to be 4 solid hours of me providing info, CR asking your questions, us having discussion on that, to make sure by the time we're done that you understand it. It will be interactive. That's why we limit it. I think about 50 people is what we're trying to get into the class, so that we can make it very interactive and make sure those questions are getting answered that you have out there.
And Dave, you do have a slew of other webinars that you can get to at theprosperityguy.com. We also have your podcast released every Friday. We've got the LinkedIn show that comes out every week. We also have this Facebook and YouTube live show. And the point we have all this is to make sure that you get all your questions answered, and you're making the best decision for your retirement, for you and your spouse, making sure that you're taking care of that and you're not the one burying your head in the sand, but you're actually out making changes and doing something. Because most of us say, we'll get to it later. Later becomes 5, 10, 30 years. And we want to make sure we take care of that now. So Dave, thank you so much for being here.
You're welcome. Glad to be here. One other thing I would tell people, and unfortunately there's not a date scheduled for this one yet either, is we just launched our Getting Safely Through Retirement 1.5 hour course. Taught it yesterday. First time, great course. Would recommend that highly. It's amazing how much a half hour, how much extra time it gives you to really deep dive into the details. We taught the concepts of this in a 1 hour course for the last year, but that extra half hour allowed me to dive into things that I've never been able to dive into before in one of these webinars, and would recommend that highly. That if you get the chance to, it's going to be launched. Next one will be towards the end of the month as well, to get signed up for that class so that you can take advantage of that knowledge as well. It's just great information. We're going to run some case studies in there that really show you what effect your mistakes can have financially on your retirement. You can see it there using the math and science.
And Dave, you also have some other webinars coming up as well. So we're going to tease that to let them know you've got some other new classes coming. So we're always consistently adding and changing and making sure that we're staying aware of everything that's happening. Even with the new presidency, that's a big thing that's going to happen too. And those changes will come as well.
Yeah, we've done a new partnership. We won't explain the details here, unfortunately. That's got away, but you're right. We've got at least 2 new webinars that will be coming out. I'm super excited about. They cover the same topics, but again, what we find is that we all respond differently to different information, that we can go back through multiple times the same concept and it doesn't click, maybe based upon certain slide decks, certain comments that are done. And we're going to have an opportunity to run a couple new slide decks into presentations. And we'll talk about the risk facing your retirement from a very well-known person in the industry that we're partnering with, that will help us continue to expand what we're doing to get you the information you need to make the right choices for you and your family.
Exactly. Well, again, everyone, thank you for joining us live. And for those on replay, thank you so much for being here. We really appreciate the support, and for sure, check us out on all these other platforms we're part of. And we'd love to see you at a future event, future podcast, any of those other things. And again, Dave, thanks so much for being here.
You're welcome.
All right. We'll see you guys next week.